This is Sonal Gupta, Head of Research Equity at HSBC Mutual Fund. 2023 has been a stellar year for the Indian equity investor, as all indices have given strong positive returns. The mid-cap and small-cap space have given almost 50% returns during the calendar year. We started the year with geopolitical concerns, high inflation worries, and rising interest rates. In this environment, government impetus to infrastructure, as outlined in the Union Budget, has supported growth. Growth has also been supported by range-bound crude prices, declining coal, gas, and other commodity prices. India's growth has positively surprised, with GDP growing at 7.8% in the June quarter and 7.6% in the September quarter. While all sectors have given positive returns for the year, the best performing sectors in 2023 have been the domestic cyclicals like real estate, capital goods, and autos. The overall equity market performance has been further aided by strong inflows, both from domestic and foreign institutional investors, as earnings expectation at an index level were largely met. FIIs invested close to $21 billion in the market versus an outflow of $17 billion in 2022. Supported by strong SIP flows, domestic equity mutual funds have invested close to another $21 billion in the equity market versus close to $24 billion in 2022. Looking ahead into 2024, we expect the growth momentum to continue. We see India's manufacturing sector on a robust medium-term growth trajectory driven by the government's infrastructure push, increased investment in renewable energy space, more localization in areas like electronics, defense, and other areas supported by the PLI scheme. And finally, India becoming a more meaningful part of the global supply chain. In our view, real estate remains another medium-term growth driver for the economy. Real estate demand has remained strong, and inventories have continued to decline in major metro markets despite higher interest rates. Overall, we therefore remain constructive on domestic cyclicals like capital goods, real estate, and cement. We are neutral on banks, as while banking asset quality is now very strong, the improvement in asset quality is already reflected. Earnings growth, however, could slow down due to margin contraction as a result of higher deposit cost. Valuations for bank, however, continue to be quite supportive. We are also neutral on the IT space, as while we expect the demand environment and growth to improve in 2024, we believe valuations are much more demanding, trading well above their 10-year average. We are therefore only selectively positive in the space. Consumer has been a weak space in 2023 as the lagged impact of price increases continued to impinge on consumer demand, and growth was subdued in most mass market categories. We expect improvement in 2024 as the high inflation fades and real incomes start to grow again. We are more constructive on the consumer discretionary space like QSR, apparels, etc., which have a strong medium-term growth potential. While we are positive on the domestic growth, in our view, several of these positives are already getting discounted in the high valuations currently prevailing in the equity market. Nifty continues to trade at 21 times one-year forward price to earnings based on consensus earnings, which is about 15% above its 10-year average. Valuations in the mid-cap and small-cap space are much more elevated, which are trading almost 33% above their 10-year mean valuation. We would therefore caution against high return expectations. Thank you and have a great 2024.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.